Hello class, this is Dr. Fenton, and what I'd like to do in this video is cover an example that will hopefully show you how individual transactions affect the financial statements. We're going to cover 12 transactions that you should be familiar with, go through them individually, and show how each one impacts 3 financial statements. So let's get started, and I'll remove the video so I have a full screen. You can see the spreadsheet I've developed. We're going to look at transactions I have on this second tab at the bottom. Here they are. We'll take these one by one, enter those in the portion above, and then we're going to see as we enter the numbers up here, they will show up in various statements I have at the bottom. I have 3 financial statements. So let's take a look at the first one. The very first transaction, we have the organizers of the new corporation contributed $100,000 in exchange for stock of the corporation. So you know that what that represents is cash being increased, and then we always have to show where did the cash come from. So with the owners putting cash in the business, this is of course is in exchange for stock. So we're going to enter $100,000 in cash and also in the common stock account. So as soon as we do this, the bottom's total down here, and we can see that in the balance sheet, cash is now $100,000. That's the only asset we have. On the other side of the balance sheet, the only item over here is equity, and it's in the form of common stock, $100,000. So after this transaction, and after every transaction to follow, we'll always see that total assets will always equal total liabilities and stockholders' equity. That's the basic accounting equation you learned in Chapter 1. The third financial statement down here is the statement of changes in stockholders' equity. I won't cover this as much as it will the income statement and the balance sheet, but we'll take a look at this at the end and see how it changed. The second transaction is the corporation paid $60,000 cash for inventory. So $60,000 is going out the door. Let's put a negative $60,000 in the cash account, and inventory then is increasing $60,000. You can see we still have not had any impact on the income statement. What we've done in this one transaction is exchange one asset for another one. We gave up $60,000 cash, but we now have $60,000 of inventory in its place. Total assets still $100,000, and nothing changed on the liability and equity section of the balance sheet. The third transaction, the corporation paid $10,000 cash for advertising that will be published during the next 6 months. So in this one we're paying for advertising in advance, and we call this prepaid insurance. So with the $10,000 cash going out the door, a negative 10 is in the cash account. Then we have prepaid advertising will be a positive 10. Again, we've traded one asset for another one, gave up cash, but now we have an asset we're going to use in the future, and this is the value of some advertising we're going to be able to take advantage of. Nothing happened on the liabilities and equity section. We now have 3 assets, and they still total $100,000. Transaction number 4. The corporation paid $5,000 cash for rent of the building used for its business. This will be an expense. $5,000 is going out the door. And then we have to again record why did this cash go out the door. It's going to be over here for rent expense. And since it is an expense, we're going to put a negative $5,000 over here. $5,000 in this rent expense has the impact of decreasing equity by $5,000. We can see this is the first transaction that affected the income statement. We now have rent expense. And as I'm going to cover more at the end, just at this instant in time we have a net loss of $5,000. That was the only thing we have now going into retained earnings. And we can see that on the balance sheet, $5,000. And now we have $95,000 in total assets, and we have $95,000 in liabilities and equity. Transaction 5. We have the corporation borrowed $15,000 cash, 1-year note. So we realize we're getting a little bit low on cash, so we decided to borrow $15,000. Cash is coming in the door. Increase cash $15,000. And again, show where this cash came from. We borrowed the money. It wasn't revenue. It was not the owners putting money in the business. It was a bank loan. So $15,000. The balance sheet still balances. Income statement was not affected. We now have $15,000 in liabilities. Total liabilities equity $110,000. Assets $110,000. So you're going to see that at all times, after every transaction, total assets must, that's just a rule of accounting, must equal total liabilities and equity. You can see at the top of the spreadsheet, assets, this equal sign here, will be equal liabilities plus stockholders' equity. And each transaction will keep this in balance. And if we enter each transaction correctly, the balance sheet will also balance. Transaction 6. The corporation sold inventory for a sale price of $75,000, receiving cash. The inventory cost the corporation $50,000. So we're selling inventory that cost us $50,000, but we're selling it for $75,000. So we have two things going on at once. Let's record the revenue. Cash is coming in the door, $75,000. Where did this cash come from? It came from revenue, sales. But we did sell inventory. That inventory cost us $50,000, so we have to reduce inventory by $50,000. And then we show the cost of the inventory that we've sold in the cost of goods sold account. And we'll put this, because it is an expense, put it in as a negative $50,000 also. Look at the income statement. We have more here now. Our revenue is now $75,000, cost of goods sold $50,000, rent $50,000, total expenses $55,000, net income is $20,000. That's equal to retained earnings. Total assets $135,000, total liabilities and equity $135,000. So a lot happened in this one transaction, but entering it correctly in this basic accounting equation format, that helps the balance sheet stay in balance, and we now have a income statement showing net income of $20,000. Transaction 7. The corporation purchased more inventory, $45,000 on account. So we're going to pay this later. We're not using cash today, but we are buying inventory and we owe for it. We're going to increase the inventory account, $45,000. And how did we get this inventory? We did not use cash, but now we owe the suppliers. So we'll put this in the liability account called accounts payable. That's a plus because liabilities are increasing. The income statement was not affected with that transaction, but inventory went up, and now we have another payable. The assets are now $180,000, and of course, the other side of the balance sheet still balances total liabilities and equity $180,000. Transaction 8. The corporation sold inventory for a sale price of $48,000. On account, we're not collecting cash at this point. The inventory cost $36,000. So again, we're selling inventory that cost us $36,000 for a sale price of $48,000. We record $48,000 as customers owing us money. So this is accounts receivable. We have sales, $48,000. The customers will pay us later. Our inventory, $36,000. Negative, because we're selling inventory, and the cost of goods sold, negative $36,000. The income statement again changed quite a bit. We have net income now at $32,000. And the balance sheet still balances, $192,000 on one side and the other. Transaction 9. Paid cash, for partial payment of the accounts payable, $20,000. Cash is going out the door, $20,000. Negative. Accounts payable we're paying off. The liabilities are decreasing, so $20,000 is on this side. With that transaction, net income was not affected, but cash went down, accounts payable went down by the same amount. Our balance sheet still balances. Transaction 10. We collected $30,000 on the accounts receivable from customers. So they purchased these items from us in number 8. Now they're paying for part of these now. $30,000 cash we are collecting. Cash is going up $30,000. Where did this cash come from? It came from the fact they owe us money. They're paying part of that off. So accounts receivable is going down $30,000. This is a common area where people make mistakes. They're thinking customers are giving us cash. We should record this as a revenue again. But no, they're not buying something else from us here. They're paying off something they purchased previously. So one asset is going down, accounts receivable. The customers don't owe us as much anymore. And of course, cash is coming in the door, $30,000. The balance sheet still balances. Transaction 11. The corporation has used $8,000 of the advertising. We paid that in advance up here. We're now using $8,000 of that. So we're going to take this off. $8,000. Still have some we have not used. The part of this we've used now is an expense. So place that in advertising. We'll put our expenses in, of course, as a negative over here. The expenses went up by $8,000. Our net income is now $24,000 equals retained earnings, and now assets and liabilities and equity still balance. One more transaction, number 12. The corporation paid a dividend to the shareholders in the amount of $4,000. So cash is going out the door. It's a cash dividend, $4,000. Negative. Why did this cash go out the door? Because of the dividend. Over here, negative $4,000. Oh, that was $40,000. Now it's $4,000. There we go. Okay, we've entered all the transactions. Again, these are some that you should be very familiar with, but placing those in the worksheet where instantly you can see the effect of each transaction on the financial statements hopefully will show you the impact that they have on your decision making when you buy something, sell something, have revenue, or have expenses. Now, this third income statement, this is sort of a bridge between the income statement and the balance sheet. Net income was $24,000. We drop this down here. Dividends were $4,000. That reduces retained earnings. That's why retained earnings is $20,000. The stock we sold is $100, sitting right here, and that's our total equity, $120,000. In the balance sheet, here's the $100, here's the $20 for retained earnings, $120 total equity, plus the liabilities of $40. So liabilities and equity would equal $160,000, and those are the assets. The key here is to make sure each transaction is recorded in the accounting equation format to keep this balanced across the top. Certain transactions, you don't have to have a transaction on one side and then the other side. So for example, back up here, number 2, we used $60,000 cash to buy inventory. Cash went down 60, inventory went up 60. Total assets did not change, nor did this side change. Okay, I hope this helped you. See how the statements are being changed as we make entries, and it should give you a good idea about impacts of certain transactions, well, every transaction really, on the various financial statements. So thank you, and please review this several times to hopefully help you understand it a lot better.